If some years ago you would have asked me, what is the stupidest way to invest? I probably would have told you, buy whatever has been going up. Now, if you were going to ask me today, what's your favorite way to invest? I would probably say, buy whatever has been going up. That's right, buy the hot stocks and then get out when they're not hot anymore. Now, before you think of me as some sort of degenerate gambler or that going long the so-called hot stocks is a stupid idea, I want you to hear me out. Momentum investing, which is just a fancy way of saying buying the hot stocks, actually has a plethora of academic backing behind it. That's right, we find ourselves right in the intersection of degenerate gambling and fancy academic studies. This fine, tiny sliver might provide an answer as to how one can build a smart portfolio that has the potential to beat the market in style. But what exactly is momentum investing? And how can investors take advantage of this anomaly? In the 1993 paper, Returns to Buying Winners and Selling Losers, Implications for Stock Market Efficiency, Narasimhan, Jegadeesh, and Sheridan Titman demonstrate that strategies which buy stocks that have performed well in the past and sell stocks that have performed poorly in the past generate significant positive returns over 3 to 12-month holding periods. And this seminal paper was like a blow to the eye of a Zelda boss to the efficient market hypothesis. Do you mean to tell me that just buying stuff that has done well over a certain look-back period can beat the market? Is that all it takes? Well, yeah, at least that's what historical data suggests. According to the paper, it is possible that the market underreacts to information about the short-term prospects of firms, but overreacts to information about their long-term prospects. Basically, humans be humans. Unlike the main assumption holding up the efficient market hypothesis, momentum investing relies on the assumption that market participants can be swayed by their emotions, and in turn, this misbehavior can be reflected in market prices for certain periods of time. Like Ben Graham said, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. So while value investing pays attention to the weighing machine, momentum pays attention to the voting machine and attempts to capture market sentiment returns. By the way, we made a video exploring which look-back periods can work best for a momentum strategy. Make sure to check that out in the description. Personally, I think there's no better explanation than the one provided in the AQR paper, Demystifying Managed Futures. Here's what the authors have to say. The economic rationale underlying trend-following strategies is an initial underreaction to a shift in fundamental value, which allows a trend-following strategy to invest before new information is fully reflected in prices. The trend then extends beyond fundamentals due to herding effects and finally results in a reversal. In other words, it follows that a catalyst occurs that pushes the fundamental value of a company up. However, due to anchoring, investors do not readily jump into the investment. And you can think of anchoring as an error that causes investors to process new information based on old and maybe even irrelevant information. Then as investors continue bidding the price up, many actually begin selling, not buying, due to the disposition effect. Another behavioral error that predisposes investors to sell winners too early and hold on to losers for too long, which is quite literally the opposite of momentum. This should slow down the stock from reaching its fundamental value, which in turn makes the momentum effect even more pronounced. As momentum continues, at some point the asset may even go past its fundamental value and investors start piling up as herding occurs, and the thing really starts looking like a moonshot. Eventually, all things must come to an end, and the trend ends with a reversal back to fundamentals. So how has momentum performed historically? Well, let's go back to the Jegadeesh-Titman paper. The most successful zero-cost strategy selects stocks based on the returns over the previous 12 months and then holds the portfolio for 3 months. This strategy yields 1.31% per month, or roughly 15.72% annualized. Now, it's important to realize that these are paper returns, so they do not account for transaction costs. For a momentum investor to be able to implement a reasonable momentum strategy, he must be wary of all the potential pitfalls. I asked our very own president, Ryan Kirlin, what pitfalls a momentum investor should be aware of. Here's what he said.
So with momentum investing, it historically had high returns or higher returns than the market. That's exciting. But in investing in something that has historically had higher returns, you also got to know that it historically comes with higher volatility. And that higher volatility is going to lead to you looking different than the market for extended periods of time. That different can be the market's outperforming a momentum strategy for an extended period of time. It can also be that a momentum strategy is outperforming the market for an extended period of time. So volatility can be good or bad, but you need to understand these so that you know in the bad times, you can stick with a momentum investing strategy. And then also in the good times so that you know, hey, this isn't going to last forever. You have an understanding there as well.
So there you have it. That's what momentum is. It's a potentially great factor to own. Seems a little simple at first when you hear about it, but it has historically worked. But investors need to know what it's all about, what it is, what it isn't, in order for them to stick with the strategy for the long term. Here at Alpha Architect, our goal is to empower investors through education. We're an asset management firm that focuses on delivering affordable alpha to our clients. If you want more educational content like this, head to alphaarchitect.com. I'll see you there.